$24 billion vanished. A once stalwart financial institution, Fortis, faced collapse, leaving thousands jobless and a global economy trembling. How did this happen? In a reckless decision, the board ignored the looming financial crisis to pursue a $24 billion acquisition of ABN AMRO, a move that cost them half of their market cap. Fortis, once revered for its stability, now left thousands of employees facing layoffs. As global market instability loomed, warning signs were everywhere: declining housing performance, escalating debt levels, but were all overlooked. The core mistake? Overconfidence in market growth despite glaring red flags. For years, Fortis basked in its previous successes, projecting itself as a reliable giant. But risk assessment models became outdated, while blind spots grew larger as the banking sector thrived on high returns. Initial enthusiasm masked the slow decay of financial stability, allowing the risks to multiply unseen. As profits soared, the warning signs began to accumulate. The housing market faltered, yet the board chose to push forward, convinced they could weather any storm. Growing exposure to volatile markets meant higher stakes in the acquisition. With initial investment losses surfacing due to trading volatility, shareholders grew uneasy as profits failed to meet predictions. The situation escalated rapidly when news of poor financial forecasts circulated, raising alarms among investors. Layoffs soon followed as reality set in. Initial profits turned into staggering losses. Fortis, unable to maintain liquidity, spiraled toward crisis. The banking system faltered, public confidence plummeted, and communities faced the fallout. The human cost was staggering. Families were left without financial support, and a once reliable institution lay in ruins. Now, Fortis found itself facing massive debt and public distress. The aggressive acquisition created an unsustainable financial burden, driven by ambitions of expansion. What appeared as early success was quickly overshadowed by mounting losses as the global crisis unfolded. Fortis's shares plummeted, freezing capital and triggering distress. The revenue model collapsed, leading to institutional failure. In the aftermath, a new financial landscape emerged, emphasizing caution. Regulatory reforms and banking stability initiatives were implemented to restore confidence. The loss of $24 billion remains a cautionary tale, illustrating that trust is difficult to regain. Financial institutions learned the hard way that each decision carries weight beyond the boardroom. As we move forward, let us not forget the human dimension behind the numbers. A stark reminder that accountability and responsible growth are not just idealistic pursuits, but essential pillars for sustainable success in finance.